Hello, guys. Welcome to just another edition of DSP Navigator. So, as we know by now, we write the DSP Navigator every quarter and aim to release it around the mid of that month. We have now come up with the DSP Navigator for June 2023. As we stand today, there are a lot of things around us that are catching headlines, making a lot of news. And our aim at DSP Navigator is to put all of that together and create asset class views and create asset allocation portfolios. So we start with something which has been very constant in Navigator presentations, which are the drivers of return. So irrespective of which asset class you are in, there are four drivers of returns: valuations, earnings, macros and flows, and the interest rate cycle. Every quarter, we take a look back on these indicators. Where do they stand? How are they looking at the cycle? And then we try to create an asset allocation view out of it. Now, in March edition of DSP Navigator, we had said that equity markets are offering a valuation comfort. And if markets go below 17,400, it will be an opportunity to add, and one can increase the asset allocation to up to 60%. Between March and June, that view had played out. Okay, Nifty was down and touched as low as 16,800, and as we speak today, it's above 18,000. So that opportunity to add to equity did come through. And we believe that equity allocation for us is at 60% now. As we stand today, there are 5 points that we are making. One is that we do not want to tinker with that equity allocation as of now. We think that the current market, even though is not as offering as much valuation comfort as it was offering in March, it's still not so expensive that one needs to exit. So we think that one can stick to the asset allocation of 60% in equity. The second point that we make here is that excessive monetary policy hikes that we have seen will affect and hurt growth, and therefore markets will reward growth. India appears to be a very sweet spot at this point in the global picture because our growth has been resilient. And if inflation does come down very, very fast, which is our expectation, then our growth will be helped further. The number 3 point that we make here is that in the March edition, we've talked about banking, automobiles, pharmaceuticals, healthcare looking good. We are still sticking to it. But there is a theme of margin expansion about which we'll talk later in this presentation. And because of the theme of margin expansion, we are scouting fresh opportunities in cement and agrochemicals as well. Fourth, and the most important point that we've written, even in the last Navigator, is that we think we are in a multi-year bull run. And the corrections that we are seeing are intermittent pullbacks and corrections. Asset allocation can smoothen the journey. So stay invested the asset allocation journey, and use the pullbacks as an opportunity to add to your portfolio. And finally, in fixed income, we are in a consolidation phase. Changes in data can bring next rally in bond, but until that happens, we recommend to wait for the data to change before further adding to the duration. So that's our 5-point summary on what we are going to talk on this report. Valuation, the first pillar, is possibly at average or slightly above average. So if we look at Nifty forward PE, we are at 18,300 kind of levels as we speak. And with an EPS of 1,000, this number tends to be closer to one standard deviation. It's not as cheap as it was in March. But having said that, India is a country which has offered very strong earnings potential, earnings growth. There has been no earnings downgrade. And therefore, looking at this number, we think the valuations are not overheated. And therefore, you can continue to be at the asset allocation or equity allocation for a moderate risk appetite at 60%. Secondly, if central banks start to cut rates and bond yields fall further, equity can become even more attractive because our earnings has solid potential, and we can go further in the buy zone. And therefore, for now, we encourage no activity per se. So two major points in valuations. Number one, they are slightly above average, but not so high that we can term them over expensive. And secondly, if bond yields ease further, from relative perspective, equity can become even more attractive. The second point is uh, earnings. Are we living in an exceptional time? Possibly, yes. So if you look at from December 21 earnings of major regions, be it Asia Pacific, emerging markets, US, which is the S&P 500 index, all earnings have been downgraded, but India's earnings has rather been upgraded. So it's a rare phenomena where Indian earnings are not seeing significant downgrades, whereas the rest of the world is losing its steam, and this brings India into a good light relatively. The second important point I would also make here is that this year, the chance of earning downgrade coming in is also very, very low. So the earnings are often very solid potential. Um, for many versions of Navigator now, we've written that PAT or the profits have two parts. One is a revenue contribution, the other is a profit margin contribution. And for quarters after COVID, the profit margin contribution has been negative, which means that the margins were shrinking for companies. And we had said we expect this to course correct and that we expect that margins will come back. And this is what had exactly happened in the March 23 results, with margins turning back into expansion. Now, why has margins turned back to expansion? Because raw material cost has fallen. Okay, so there was a significant input price that was very high, and because of which margins were contracting. And now with, as you know, commodity prices have eased, WPI is trending lower, the margins have come back, and that has reflected in the recent results. And we think this could be one important theme for the rest of the year, that margins will add to profitability and it will make earnings more solid going forward, and we will scout for themes which will benefit from this margin. Earnings are very robust in the select sectors, especially the ones we like. So consumer discretionary, financials, healthcare, industrials, etc., have shown very, very robust earnings. So again, two takeaways from earnings. A, India as a country is having very healthy earnings, and this could possibly be the year where we do not see a earnings downgrade. And secondly, margin expansion is finally here. That could drive the next leg of earnings recovery and will be very important in bolstering the Indian market through earnings. The third pillar, apart from earnings and valuations, is the macros and flows. If you look at the global lead indicators, they are still dwindling down. So even though we've been, talking about a slowdown for a while now, and it has really not come in, the lead indicators for global economy are still dwindling down, saying that it. Hold on. I'll go ahead. The lead indicators for global economy still dwindling down, saying that the chances of a slowdown cannot be fully ruled out. However, when we look at India and India's high and low frequency, data, it is very difficult to find marked slowdowns. If we look at services PMI, manufacturing PMI, consumer sentiment, they're all inching up. Real GDP, in fact, for the last quarter, which was the March quarter, given a shock or a positive surprise of 1%. So the expectation was of 5.1%, and we got a real GDP growth of 6.1%. FY23 growth was expected at 7%, but we've closed the year at 7.2%. So growth is definitely bringing about positive surprises, which is also seen in the high frequency data of PMI, sentiment, index, and therefore a marked slowdown in Indian economy is hard to find. Indian economy is being helped by least constructive monetary policy ever. So even with RBI increasing the interest rates, we have surplus liquidity. The rates today are nowhere close to the peak of past cycles, such as the financial crisis or twin balance sheets, etc. the velocity of money could go up with digitization coming in. All in all, the monetary side of the system is helping India bounce back on growth. And finally, private capex is very strong now. The whole journey of capacity expansion in India was led by public sector so far. So it was all government driven. But the recent data that we see, BSE 500 capex or share of orders that are being backed down by private sector, this data is fast improving. So there are three parts to capex: public sector, private sector, and the household sector. So far, we've had the public appetite. Now the private appetite is coming in, which is a real signal of animal spirit. It's a signal that private sector is looking to invest in India, and that is a good sign and for growth of India. DSP capex tracker, the scorecard does look healthy. FI flows have come back in India. It has yet not got its fair share of FI flows. We started 2023, the first quarter, we saw the outflows. Only in April and May, we've seen about 6.5 billion come back to the Indian equities. We think we will get more of these with dollar easing, emerging markets becoming more favorable, and within emerging markets, India having a strong growth and earnings potential. We think more money will, possibly come in India. And so far, the money that has come in the sectors we like. So that also, bolsters our stance. Now, the final pillar. We've talked about valuations. We've talked about earnings. We've talked about the macro environment where India's growth, especially monetary economy supported growth and capex growth, looks very strong, and the flows have just started to come in. We now move on to the fourth pillar, which is the interest rates, and we think it could be a case for the long pause. As a recap, if you put in, policy rate hikes by central banks of 10 major currencies globally, 2022, we have seen the highest hikes. We have seen the most hawkish central banks globally in 2022 in the last 2 decades. And this is now, likely to change. So what has gone up one way is likely to course correct as well. 2023, we are on a pause mode and we are likely to take a longest pause here. But if we look at the yield curves for both India and US, Indian yield curve is flat. And we think that once RBI starts to cut rate, it's the shorter end of the curve that will ease. The longer end could ease by a few points or could remain where it is because the growth expectations will be very strong. And US yield curve still is inverted. It goes out to say that, the probability of a recession in US cannot be fully ruled out. So inverted yield curve in US, and even when Fed says that they're pausing for now and they may hike later, but we think they're just buying more time because with US economy slowing down and inflation coming off really fast, there may not be another opportunity for Fed to hike. So that's about the interest rates that we think we are here in the pause zone. We are likely to linger here for slightly longer. In terms of sectors, so COVID was all about the strong getting stronger, but now the recovery is finally trickling in. So on the rural front, let's say the FMCG volume has started to pick pace. Two-wheelers are doing better. So the recovery is getting more broad-based, and rural recovery could possibly help. Within the financials, banks have seen a huge run-up, but now possibly NBFCs could do better, and there's a case to pass the baton from banks to NBFCs. As I said at the start, margin expansion is here, and these are the FY24 estimates of margin expansion in sectors like cement, auto, durables, FMCG, chemicals are likely to benefit from the theme of margin expansion. Just quickly sum it up, equity, we said stay invested, and we've already spoken of the sectors in detail. Duration in debt, we say that be invested, don't be underweight or overweight duration. There was a good time between when yields were at 7.5 that we decided to go overweight on duration. Now yields are at 7 and we have a more neutral stance. In terms of commodities, we think that this normalization may continue. So there is no clear, bull case per se for commodities, except in precious metals, especially gold, because dollar is easing very, very fast, and dollar easing can help gold touch a new lifetime high. And if that happens, gold will be in a fresh bull market. How to position your portfolio? So depending on the risk appetite, this is the equity allocation that we suggest at this time. This is exactly the same as the March version. Like we said at the start, we do not want to tinker with asset allocation at this point, where markets can go up at least slightly up from these levels. This is how you can position your portfolio using DSP only funds. So this is a portfolio example for conservative strategy, moderate strategy, aggressive strategy, and passive strategies alone. I think DSP is very big on the passive space, and it is possible to build a full portfolio using our passive products alone. Some fun recommendations, some books, podcast articles that we've been reading. I hope this adds value, and I hope that taking stock of valuations, earnings, macros, and flows, and the interest rate cycles periodically makes your investing journey even richer. We advise you to continue sticking to your asset allocation. And like they say, investing should be more like watching paint dry or watching grass grow. If you want excitement, you should rather go to Las Vegas. So we hope that in investing, inaction is the biggest action. And as of now, it's the time to sit tight. Thank you. Thanks for joining.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.